Hello, everyone, and welcome to Taxation for U.S. Citizens and Green Card Holders. My name is Marilyn Wagner, and I am the Chief Experience Officer at the Credit Union. This is actually our second webinar of the year, but also held during a very important time, tax season. Many of us don't like it, but it is a necessity. So we wanted to make sure that we provided you the necessary information you need to make informed decisions regarding your taxes. Now, don't worry, this webinar is being recorded. So after this session, you will receive an email in your inbox that has a link to the recording. So you can go in, you can review the questions, you can review the content, and make sure and share it with any loved ones. Additionally, at the end of the presentation, we do have a Q&A session. So Dale and Jose will take a session where they'll take your questions, they'll answer as many as they can. So make sure in the lower right-hand side, you take a look at that and it says Q&A, put your questions there, and they'll make sure to address them at the end of the chat. Additionally, I do want to say that we are so close to opening our new branch in the DC area. So if you come to the IDB building next week, we will be close, we'll be ready to receive you, and we're very excited as we are a safe and secure organization. Now, I'm so happy to give you an overview of our two presenters. Jose Sobrado is the president and founder of MG Capital. He has been a CFA charter holder since 2010 and a finance professional for more than 15 years. And additionally, we have Dale Mason with over 25 years of experience in international tax consultancy. So because of these two speakers, we feel that you are in amazing hands. So without further ado, Jose, will you please join me on the stage and begin the presentation?
Thank you, Marilyn, for those kind words. Good morning, everyone. We are very happy to be here with you this morning to talk about taxation for U.S. citizens and green card holders. The session is for U.S. citizens and green card holders. And with tax season upon us, of course, we hope to leave you in a better position when it comes to meeting your obligations and your tax return needs. Again, this session is for U.S. citizens and green card holders. If you are a G4 visa holder, this might not be the session for you. We had one yesterday for G4 visa holders. I will start with a brief disclaimer. The United States tax law, of course, is very complex, probably by many measures, the most complex in the world. So unfortunately, nothing that we can say here today should be construed as individual tax, financial, or legal advice. Please seek professional tax and legal assistance based on your own specific sets of facts and circumstances in order to understand not just the rules that we're going to talk about today, but perhaps the exceptions and the exceptions to the exceptions that may apply to your own individual circumstances. We have a packed agenda for today. We're going to discuss basic general concepts about tax residency and tax changes, perhaps tax changes related to 2024. But we're also going to get into the more technical details of things like reporting of foreign financial assets and, of course, the all-important exit tax. Please, as we go along, take time to put your questions in the chat. We will leave time at the end of the presentation to discuss your questions. And that will be also very valuable for many of you. To begin with tax residency in the US means paying taxes on your worldwide income. If you're a tax, that may not be the same everywhere in the world. It is for most countries, and it's certainly the case here in the US. If you are a tax resident of the US, you owe taxes to the US government on your worldwide income. No matter where that income is generated, you have to declare it in your tax return and pay taxes accordingly. Of course, if you're a US citizen, you are always a tax resident of this country. It doesn't matter whether you are physically present in the US or not. As a US citizen, that doesn't matter. You will always be considered a tax resident of the US, taxable on your worldwide income. This might not be the same in other countries. In other countries, you're only a tax resident, even as a citizen, if you reside, if you spend substantial time in that country. The US is one of a handful of exceptions in the world where the residents, the citizens of the country are always tax residents, regardless of where they reside or where they spend substantial presence. But other than being a US citizen, you can also be a tax resident of the US if you have a green card, if you meet the substantial presence test, or if you're married to a US citizen or green card holder that elects for you to be a tax resident for tax purposes. So we're going to discuss each one of these situations in a little bit of detail. Beginning with the green card test of tax residency. If you apply for a green card and eventually receive one, you will be a tax resident beginning from the first day that you are present in the country with that valid green card. It could be that you receive the green card while you're outside of the US. It can be mailed to you, or you can earn it while you're outside of the US. In that case, you're not automatically a tax resident at the moment you get the green card. You will be a green card tax resident the moment you return to the US, the moment you're physically in the country for the first time with that valid green card. Now, if you earn the green card outside of the US during a year in which you don't travel to the US, you will become a tax resident then on January 1st of the following year. So if you haven't returned to the US by December 31st, you will automatically be a tax resident from January 1st. Now, this means that you could be partially a non-resident and a resident in the same calendar year. This is called dual status tax residency, and it's perfectly fine. It could make your tax return a little bit more complicated, but it is perfectly okay to be a tax resident part of the year and a non-resident another part of the year. It can also happen that you could become a tax resident not just under the green card test, but perhaps under some of the substantial presence tests that we will discuss in a minute. In that case, you will always be a tax resident from the earliest of the two. If you qualify under both tests, it is the earliest of the two that will determine your exact date of tax residency. So what is the substantial presence test? If you spend substantial time in the US, of course, you can also become a tax resident, regardless of your green card status or your visa status. Probably the only exception, or the most important exception, of course, could be if you're a full-time employee of an international organization like the IDB. In that case, your days are exempt. Your days of presence do not count for purposes of becoming a tax resident under the substantial presence test. That is why you may know that many of your G4 colleagues that spend their entire careers in the US living and working here on a permanent basis will be considered non-residents, regardless of how many days they spend in the US. There are a few other visas that provide exceptions like that, but only for limited periods of time. Pretty much any other visa or any other status outside of the G4, eventually your days of presence will count, and after enough time in the country, you will become a tax resident. So what is the exact rule with regards to substantial presence? It is 183 days is the magic number. If you spend more than 183 days, that count, of course, international organization, full-time employees do not count, but any other days that count, if it's more than 183 days, then you will become a tax resident. Now, it doesn't have to be days in a single calendar year. The rule is more specific than that. It's 100% of the days from the first calendar year. It's 1/3 of the days from the year before that, and plus 1/6 of the days from the year before that. So you count 3 years back according to this formula, and if the result is more than 183 days, you will become a tax resident. That's very important to understand. Perhaps you don't spend 183 days this year. Maybe you spend only 182, for example. That wouldn't make you a tax resident, but it does mean that the following year, you can only spend a maximum of 123 days. And if you only spend 122, then it means that the following year, the most you can spend is 112 days before becoming a tax resident. It works out to an average of about 4 months per year that you can be physically in the country without triggering the substantial presence test. And this can affect even people that come on a tourist visa. Maybe you have family members that maybe now or in the future are interested in spending time with you here. Under a tourist visa, it could be that someone can spend more than 4 months in any calendar year for many years into the future. And if that happens, then maybe your grandma who visits here on a regular basis will become a tax resident of the US. And again, it means worldwide income, assets abroad, income abroad, investments abroad will become taxable to the US. So there's a third way in which one can also become a tax resident, which is optional. Under the green card test or the substantial presence test, you either are a tax resident or you are not. But there's also an option to become a tax resident if one is married to a US person. A green card holder or a US citizen can elect for their spouse to become a tax resident. So maybe you're a G4 visa holder married to a US citizen or green card holders. You are a non-resident per your visa status, but your spouse can elect for you to become a tax resident. The immediate consequence of that is for the non-resident that worldwide income becomes taxable. So if the non-resident has assets, investments, income outside of the US back in their home country that normally would not be subject to US taxes, it would become subject to US taxes if they decided to make this election, right? So that wouldn't necessarily be a good thing for the non-resident. Why would this be interesting perhaps to a married couple under this situation? Well, it could reduce the taxes owed by the US person. The US spouse, the green card holder or US citizen, if they don't file jointly with their spouse, they have to file as married filing separately. The tax rates for people married filing separately are higher than for people married filing jointly. So by electing for the spouse to be a tax resident and filing jointly, the US person, the green card holder or US citizen, can benefit from higher standard deductions and lower marginal tax rates. So everybody's situation could be different. In some cases, it could be advantageous. In some cases, perhaps not. But if you are considering this type of election, keep in mind that the election can be made once and revoked once. But once revoked, it cannot be made again in the future. So think about not just your current circumstances, but also how things may look in the future. Perhaps it may be beneficial for you to make the election now, but if you need to revoke it in the future for whatever reason, you won't have the benefit of being able to make the same election again in the future. So planning ahead might be important. So as we said, reporting of worldwide income is the key to being a tax resident. US citizen, green card holder, and non-residents under the 6013G election must report income derived anywhere in the world on Form 1040. 1040 is the annual tax return that you file as a US tax resident. Not to be confused with 1040NR. There's a specific form for non-residents and a form for tax residents. It happens a lot in practice that people, especially non-residents, get confused about which form to use. Now, if you're a tax resident of the US, paying taxes on worldwide income, some of you may wonder if you're exposed to double taxation. Just because you're paying taxes in the US does not mean that if you have income outside of the US, you wouldn't pay taxes perhaps in those other jurisdictions. So what happens in that case? How do you avoid being doubly taxed? Well, as a tax resident of the US, you have the ability to get credit for foreign taxes. Taxes paid outside of the US are eligible for credits in your US income tax return. So this is the mechanism that avoids double taxation. Generally speaking, If you do have income outside of the US as a US tax resident, you will usually end up paying the higher of the two tax rates, right? Whatever rate is the highest, that's generally what you should end up paying after net of the foreign tax credits that you can take on your US tax return. Now, there are no foreign tax credits on local returns, on state returns, so there could be some inefficiencies. You could end up perhaps paying a little bit higher taxes if you have foreign income. So that it's on a case-by-case basis. You should understand your particular situation and taxation of the state where you're a resident. So as I said, Form 1040 should be filed every year on April 15th by U.S. tax residents, citizens, green card holders, and other tax residents. Now, April 15th is the date by which tax returns should be filed and taxes paid, but you are allowed to extend your tax return. You can use Form 4868 to extend your filing deadline from April 15th to October 15th. Now, keep in mind, if you're considering doing this, that only extends the date by which you have to file your final tax return. It does not provide an extension on when payments are due. So if you do owe any money at the end of the day and you did not pay it by April 15th, you will be assessed interest and penalties. State returns also are generally due by April 15th. Now, the IRS also requires you to make payments in advance of April 15th. Those are called quarterly estimated tax payments. You should be making estimated tax payments in advance of April 15th if you expect to have a tax liability by April 15th. This affects U.S. citizens who earn wages from the IDB or other international organizations that are not subject to withholding. Most other U.S. employees are subject to withholding of taxes on their wages. U.S. citizens working for IDB do not, so you do have the responsibility of making quarterly estimated payments. Same as retirees who get a pension from international organizations, you should be making estimated quarterly payments for the taxes you will owe on April 15th. So when are quarterly estimated payments due? They are due on April 15th, June 15th, September 15th, and January 15th of the following year. What is the penalty for not making estimated quarterly payments? It's based on interest rates, and currently it's about 7% per year. Maybe missing these types of payments was not an issue some years ago when interest rates were less than 1%. That's not the case nowadays. Nowadays, 7% interest rate may hurt you at the end of the day if you do not make the necessary quarterly estimated payments. Complete Form 2210 if you underpay to report your underpayment of estimated quarterly payments. So has anything changed in 2024 with respect to previous years? So every year standard deductions are adjusted based on inflation. Here are the standard deductions for 2024. Other than that, there's really nothing significant that has changed in the way you will be taxed for 2024. Of course, you can always consider itemized deductions as opposed to standard deductions. Most people in the U.S., the vast majority of U.S. tax filers take advantage simply of the standard deduction. There has been a lot of restrictions in what can and cannot be itemized. So nowadays, there's very few options for itemization of expenses. So most people use the standard deduction. Property taxes and state income tax deductions are capped, and so is interest on home mortgages. Deductibility of interest on home mortgages is limited to interest on up to only $750,000 of principal of capital due on the mortgage. Now, having said that, of course, if you do the math, because interest rates have increased, it might not take much for those interest payments to exceed the standard deduction. If you do have more than $750,000 worth of mortgage, If you're paying anything more than 3.9%, then your interest payments are probably going to exceed the standard deduction. So that might be something to consider. Unreimbursed medical expenses over a threshold of AGI 7.5%, as well as charitable contributions, are also deductible. So having said that, Dale will now join us and walk us through foreign financial information reporting. Thank you, everyone.
That was great, Jose. Thanks very much. Hello, everybody. Now my topic is foreign financial information reporting. So not only does the government want you to pay taxes and use the right form and report your full worldwide income, but in some circumstances, you may also have to generate additional reports the U.S. government wants to have. Now, these foreign financial information reports won't cost you $1 extra in tax, but if you don't file them, if you meet the threshold requirements, if you don't file them, they could cause you to have large penalties. So again, everything I'm going to tell you here is with regard to information reports in the next few minutes. You always have to report your full worldwide income to the U.S. government, but if you just have these information reports, they don't cost you any additional amount in tax. I just want to emphasize that. So let's start out with the most famous information report, which is called the Foreign Bank Account Report, or FBAR for short. It's called the FinCEN Form 114 in addition to FBAR. So you can Google all these terms and you'll find this report. Who should file this report? It's any U.S. citizen, green card holder, or other U.S. tax resident with a financial interest or signature authority over foreign financial accounts that ever exceed $10,000 in the aggregate at any time during the calendar year. So what you do is, if you're a U.S. resident, U.S. citizen, U.S. tax resident, you look to your foreign financial accounts, you aggregate them all, and then you look for the highest account balance that you had in those foreign financial accounts over the year. And if they exceed $10,000, the equivalent of $10,000 at any time during the year, then you're required to report each and every one of those foreign financial accounts on this FBAR form. Now, what is this signature authority I'm talking about? The signature authority is simply the ability to move money in the foreign account. It may be that you have a relative, a mother, a father that needs assistance. They're getting elderly and they need assistance when it comes to their financial affairs, and they've given you signature authority. The money is not yours, but you can control the money. That's what signature authority is. So if you have a signature authority or foreign financial accounts that exceed $10,000 at any time during the calendar year, you may have to file this FBAR report. Next slide, please. Now, this FBAR report is filed electronically and is not part of your U.S. income tax return Form 1040. It's not part of it. If you have this filing requirement, you must file it electronically. As a matter of fact, if you try to paper file this form, you may get a penalty notice saying, no, you have to electronically file it. You file it by paper, it will cost you a $500 penalty. So file this report electronically if you have to fill this out. And this report is due by April 15th, but if you don't file it by April 15th, then it becomes due October 15th. Now, this is very strange. It becomes due automatically. If you don't file it by April 15th, it becomes automatically due October 15th without you having to file any type of form. So just know that you can actually extend it to October 15th if you miss the original filing deadline of April 15th. Next slide, please. In addition to this foreign bank account report, in which you have to list the name of the financial institution, your account number, the address of the financial institution, and the highest account balance that you've had over the year on that FBAR report. In addition to that report, you may have to file the so-called Specified Foreign Financial Asset Report, Form 8938. Now, this IRS Form 8938 is part of your U.S. income tax return. And this report, if it was due, has been due since 2011. This report was created by the IRS in 2011 and has been due ever since on an annual basis. It's included again in your U.S. income tax return. And this report, even though it's also regarding foreign financial assets, is in addition to the FBAR report. It may be that you have, let's say, a foreign bank account worth $60,000, let's say, and you're single and you're living in the U.S. Well, you may have to file that report, a report on that one bank account that was $60,000 on both the FBAR report and the Form 8938. So don't think just because you've already reported it on one of these reports that you don't have to file the other one. You may have to file both the FBAR report and the 8938. Now, thank goodness, the threshold amount that you have to report the 8938 is not that small, $10,000 as it is on the FBAR report. Instead, if you're single and you're living in the United States, the threshold amount in which you have to report the 8938 is $50,000. And if you're married filing a joint tax return living in the United States, the threshold amount for you to have to report the 8938 is $100,000. Next slide, please. So I won't bore you with the small differences that there is between the foreign bank account report, the FBAR, and the Form 8938. You can look that up in the instructions. But here's what I want to say about this. These are complicated instructions, and they list all sorts of accounts that have to be, or that are required to be filed on both the FBAR report and the 8938. But I just wanted to say this. It's important to note that the IRS wants to find out about your foreign financial accounts. So when in doubt, report it. If you're at all in doubt about whether or not an account, a brokerage account or a life insurance policy, a foreign life insurance policy or what have you is reportable, my suggestion is to report that account. You should be conservative. And the reason is, again, this reporting of the foreign financial accounts is not going to cost you one additional dollar in tax. It's simply informational. So you can go through the instructions and figure out which account goes on which form. But like I said, when in doubt, be conservative and report it. Next slide, please. The one thing that is very, very important for IDB retirees to note, and even non-retirees in some cases, is that the IDB pension is considered a foreign pension and is specifically considered a specified foreign financial asset for purposes of the 8938. Let me say that again. The IDB pension is considered a specified foreign financial asset for purposes of the 8938. And generally, the value to report on the 8938 is the gross distribution amount that's reported to you on the Form 1099-R. So if you're not familiar, if you're not a retiree, what's going to happen is once you retire, and if you're a U.S. tax resident at the time you retire, you're going to start getting taxable distributions from the IDB pension, and you're going to the IDB is going to send you at the end of the year a form, a tax form, an IRS tax form called a 1099-R. And on that 1099-R is going to be the amount of the gross amount of the distributions that you received during the year, as well as the taxable amount of those distributions. And so for purposes of figuring out the threshold, that $50,000 or $100,000 I was talking about earlier, you use the gross distribution of the IDB pension when it's paid to you for that year, and that information will be on that 1099-R that you'll receive probably in January of the following year. Next slide, please. So here's another information report. It's not going to cost you additional amounts of tax. It's just informational in nature. So if you are a U.S. tax resident, we've already gone through who those U.S. tax residents are, U.S. citizen, other tax residents, and you receive a gift or an inheritance from a non-resident that's during the calendar year that's in excess of $100,000, you have to file this information report called a 3520. You report the date of the gift or bequest that you receive, the description of the property, and the fair market value of the property received on this Form 3520. It's due on or before April 15th of the following year after you receive the gift or inheritance. And it's very important that you fill this form out, this 3520, because again, there are penalties for not filling it out. And again, it has to do with U.S. tax residents receiving gifts or inheritances from a non-resident, and you would report it if you get a gift or inheritance valued at over $100,000. Next slide, please. So here's the reasons that you should definitely file these information reports. The penalties are generally $10,000 or greater, and in the case of a gift or bequest from a non-resident, the failure to file is generally 5% of the gift or bequest for every month that you fail to file it, up to 25% of the gift or inheritance that you received. So these are quite high penalties. So please make sure if you have to report them, do so. Next slide, please. So now let's go over the exit tax. Yes, there's such a thing as the exit tax in the United States. Who does this apply to? The exit tax would apply to U.S. citizens who've relinquished their U.S. citizenship, and it doesn't matter how long that he or she has held their U.S. citizenship. Just the fact that you've held your U.S. citizenship for one day and then relinquish it is enough to make you exposed to the exit tax. In addition, green card holders who cease to be lawful permanent residents if they've held their green card in at least 8 years out of the last 15 years. Typically, that just means that you've held your green card for more than 7 years. If you've held your green card for more than 7 years and then you either give it up or you have it revoked by the Immigration Service, you could then be exposed to the U.S. exit tax. But in addition to being a U.S. citizen or a green card holder who gives up their citizenship or green card status, in order to be subject to the exit tax, you would also need to meet the net worth test or the income tax test. Next slide, please. So most of our clients don't meet the average annual tax liability test to be exposed to the exit tax. Typically, they meet the net worth test, which is the day before you give up your U.S. citizenship or green card. If your net worth is more than $2 million, then you would become subject to the exit tax. And what is net worth? It's the global assets that you have minus global liabilities. But what you need to take into account also is the present value of all of your pensions, including the IDB pension. So when you take into account all of your investments, your real estate that you own on a worldwide basis, you subtract your mortgages and any credit card balances that you have. In addition to that, you have to add on the gross amount of the present value of your IDB pension into the calculation. And most people, a lot of people have that are from international organizations, including the IDB, have a net worth of over $2 million just because they're going to be receiving their IDB pension in and of itself. So many people meet the net worth threshold because of your wonderful IDB pension. And so what are the consequences of giving up your citizenship or giving up your green card and having an over the $2 million net worth test and being subject to the exit tax? Next slide, please. There are many types of consequences when it comes to the exit tax, but one of the major ones that affects most international organization employees, including the IDB employees, is that if you trigger the exit tax by giving up your citizenship or giving up your green card, you'll be subject immediately to the present value of your accrued benefit in the IDB pension, and it's treated as being all received. The entire present value of your pension is treated as being received on the day before expatriation. And so you'll be subject to tax on the taxable portion of all of the present value of your future stream of income all immediately if you become subject to the exit tax. So this can be completely financially devastating. So you want to avoid this at all costs. Next slide, please. So if you are even considering giving up your green card or giving up your U.S. citizenship, by all means, seek assistance from a qualified attorney or CPA that understands the exit tax, because you do not want to have the entire present value of your IDB pension become immediately subject to tax. And with that, thank you very much. We're going to move on to questions. To see, we have quite a few questions, so that's great. But if you haven't put your question down, please put it in the Q&A at this time. And here's some services that Jose and I perform. We do tax planning. We have individual 45-minute consultations with clients, and you can see the list here. I'm going to move on to our contact information is here if you need to get in contact with us. But now we'll go over to the Q&A session.
First question, Dale. I don't know what Form 7R is. If we mail 7R to tax unit, do I receive a receipt confirmation?
Well, the Form 7R, as I understand it, so Jose and I do not work for the IDB. And so the Form 7R, as I understand it, is a tax reimbursement form that is filled out by retirees. So you'll have to ask the tax unit whether or not you get a receipt for mailing in your Form 7R. We don't know that information.
And related to pensions, does the bank reimburse according to the tax bracket of the retiree?
It's my understanding that it's a fairly complicated calculation, and you'll have to ask the tax unit how they do that, because again, Jose and I don't work for the IDB. But my understanding is a calculation is done to figure out their total tax liability, and then the percentage of your basically adjusted gross income that is the IDB adjusted gross income taxable amount versus your other income that goes into adjusted gross income, and the taxable amount of that other income, like investments, your spouse's retirement, etc. And then they take a ratio. So it turns out, I think, that you get reimbursed the average tax rate of that the IDB pension is causing in your income tax return. But again, that's a good question for the tax unit of the IDB.
I guess the next question is interesting, Dale, considering everything that's going on with the federal government. This person wants to understand the frequency with which the IRS conducts audits for taxpayers connected with international organizations.
So I don't have that information. We all don't have that information. They don't get that specific when it comes to international organization employees audits. A few years ago, they said this was now maybe 10 years ago, they said they were cracking down, and they would increase their IRS audits of international organization employees. They did that for a couple of years, but then it stopped. And I don't know what the percentage is of IRS audits that specifically target international organization employees. The best thing you can do is do your taxes and do them correctly.
And regarding audits and doing your taxes correctly, somebody wants to know, how do they keep records? How do they prepare for possible audits? How important is that?
Well, the general rule is that you should keep your tax returns for 7 years. And one of the reasons for that is the IRS, if you file an actual tax return, the IRS can audit you generally back 3 years. But if the IRS detects that you've committed fraud or you have underreported your income by more than 25%, then the audit period is not 3 years, but 6 years. And so it's important that you keep your records for at least 6 or 7 years, just in case of audit. And what you'd want to do is, if you itemize deductions, then you want to make sure that you keep all of your receipts that you have for those itemized deductions, such as medical expenses and home mortgage interest and property taxes, and make sure that you just keep those receipts and records on file.
I think that answers also the next question with regards to proof of income regarding your salary. Again, nothing goes attached with your tax return. You simply keep your information, keep your records for the possibility of an audit.
Right, unless you're a U.S. citizen and you're working for the IDB, you will, of course, get a W-2, and will keep that information, that record. Now, if you're a green card holder or a G4 visa holder who's not subject to tax on your compensation income, then I would say there's no real reason to keep the fact that you don't have any document, because it's just non-taxable. But if you feel safer to at least know how much you received during the year, then you should probably contact the Human Resources Division of the IDB and ask for a statement that says how much you made during the calendar year, and just keep that on file.
And the next question is regarding children. So regardless of age, anybody that meets the requirement that owes taxes, that meets the requirement to pay taxes to the U.S. must file a tax return, including children 18 or under. And they would have to file separately. Children cannot file jointly with their parents.
Yes, and in the case of unearned income, meaning investment income earned by a child who I believe is under 23 years of age, a dependent that's under 23 years of age, they could be subject to what's called the kiddie tax, Kiddie. You see, the IRS got a hold of a tax strategy many years ago in which very wealthy U.S. citizens were shifting their investment income to their children, so that their children that didn't have a tax filing requirement at that time were receiving investment income of a substantial amount and reducing the tax on the high marginal rates that were being charged on that investment income by the parents. So they were playing the tax bracket game. But that has been done away with through what's called the kiddie tax.
The next question is asking about reporting for a retirement account, Fondo de Pensiones. I'm not clear if they're talking about the IDB pension or some other type of foreign pension, but maybe you want to comment on both, Dale.
Let's just see here.
Number 9.
Yeah, pension fund. So if you are a U.S. citizen, a green card holder, or other tax resident, and you receive an IDB pension, a portion of that pension is going to be subject to U.S. tax. And what you should make sure of is the IDB knows your resident status. If you were a G4 visa holder and subsequently you were allowed to stay in the U.S., obtain a green card, and maybe move on to U.S. citizenship, you want to inform the IDB so that they can provide you with a tax form called the 1099-R and provide a copy to the IRS of that 1099-R. And then you'll be subject to tax based on the taxable portion of your IDB pension. If you're a U.S. tax resident and you have an IDB pension, and maybe you have another pension that you earned in a foreign country prior to coming to the U.S., again, as Jose was mentioning, if you're a U.S. tax resident, green card holder, U.S. citizen, you're subject to tax on your full worldwide income, including pension income that you're receiving from a foreign country. So you would have to report that on your U.S. tax return if this was a pension other than the IDB pension that was coming from a foreign country.
Somebody requested a green card over 2 years ago, but they haven't received it yet. They seem to think that they have satisfied the substantial presence test, and they filed taxes last year. They want to understand their status and whether the credit union should be considering them as a resident or a non-resident. So as we discussed regarding tax residency, you haven't met the green card test, you haven't spent a day of presence yet with your valid green card. And if you're a non-resident working full-time for the IDB, you're also not accruing days towards a substantial presence test.
Yes, now it is possible that you were allowed to stay in the U.S. because you're getting sponsored by a green card holder or U.S. citizen child or spouse, and you've retired from the IDB, And so therefore you're retired from the IDB and your days of presence started to count because you're no longer a full-time employee of the IDB. And if your days of presence started to count and you're waiting for your green card while you're in the US, those days are counting for purposes of the substantial presence test of tax residency. So you could have become a tax resident under the substantial presence test.
Now, regarding real estate owned abroad, real estate, unlike financial accounts, is not reportable. Only income is. So if you own a property abroad, you have to report any income that you earn from the property or capital gains in the event that you sold the property and had a gain. But just holding an asset, owning an asset abroad, does not create a reporting obligation.
Yes, that's right. And all of the forms that I was mentioning, the FBAR and the 8938, have to do with foreign financial assets, so not real estate. So if you do have real estate, as Jose was mentioning, and it's not generating any income, you have no reporting obligation at all, either on your income tax return or as well as on these foreign financial information reports, because they're not financial. The property is considered real estate. But if you generate any income, then that rental property needs to be reported on your U.S. tax return under what's called a Schedule E of Form 1040.
And with regards to estimated tax payments for your IDB pension, yes, if you are earning a pension, part of it is taxable. You are receiving a tax supplement, but you have to make sure you make estimated quarterly payments. Otherwise, you will be subject to interest on the missed payments. The next question is, is the IDB pension considered eligible deferred compensation, Dale, under the expatriation rules, section 877A?
I think we might have an attorney on the line here. No, this is ineligible deferred compensation because the IDB pension trust is a foreign trust and therefore subject to the rules regarding ineligible deferred compensation. And that's why the entire present value of the taxable portion of the pension has to be put into U.S. taxable income on the day before expatriation.
If a resident converts to U.S. citizen, how taxes are affected? Of course, that has an immediate impact on the taxation of your wages from the IDB. Green card holders do not pay taxes on those wages. U.S. citizens do, and will have to start making estimated quarterly payments. It may also have an impact on your exposure to the exit tax, right? Exit tax. Once you're a U.S. citizen, you can remain a U.S. citizen regardless of where you decide to relocate anywhere in the world. So it also changes your exposure to the exit tax.
That's right. And the next question, sales of property gains. Is there any difference between green card holder and U.S. citizens? No, there's not. So they're always very similar, the taxation of U.S. citizens and green card holders. Basically, both are considered U.S. tax residents, and that's why you have to report your property's gains no matter where they're located in the world. But the taxation of capital gains taxation for those property gains is the same for U.S. citizens and green card holders. And the next one is the IDB pension reported on Form 8938 and not on the FBAR? Yes. So the 8938, definitely it is reportable on the 8938 if you meet those threshold requirements. But there's a specific exemption for U.S. qualified pension plans on the FBAR. And so even though the IDB pension may be subject to reporting on the 8938, it's specifically exempted from reporting, not required to be reported on the FBAR.
Next question has to do, I think we answered the next question regarding proof of income. And the one after that is about tax return wrongly archived and not processed.
Yes, so unfortunately, the IRS, and this is not a current issue, but the IRS is not administratively accurate a lot of the time. They post things to the wrong accounts. And sometimes when you get on the telephone, it takes hours and hours of waiting time to get a hold of an agent So the only thing we can tell you is just to keep trying.
Does the IRS deduct exit tax every year from Social Security payments?
No, you'd be required to pay the exit tax all up front. There would be no allowance for you to defer the payment of the exit tax. If you do defer the payment of the exit tax, there's an interest rate and an assessment and a penalty. So you'd have to pay the exit tax, and they won't withdraw it from Social Security payments.
And we have answered the next question regarding real estate outside of the US. And then the last question is about somebody who's concerned of US citizens living abroad and perhaps not understanding all of their obligations. What are the consequences? By the way, that happens often. Many US citizens sometimes leave the country as children and perhaps never realize, spend many years growing up outside of the US, become adults and never realize that they had a tax filing obligation. It happens a lot in practice.
There are still amnesty programs for people that meet certain criteria that are US citizens, and they've been in foreign countries for many years, and they just now realize that they had a US tax filing requirement. So they could potentially take advantage of these reduced penalties under certain amnesty programs.
I think that's it. If there are no more questions, I think we'll turn it back to Marilyn.
That was not as many questions as yesterday. Thank you, everybody. If you do have questions, we're actually 9 minutes to closing, so great timing. I want to thank you both for being such a great part of the organization and helping us with this webinar and helping our membership. I do want to remind everybody that this webinar was recorded, so please make sure that you go and you take a look at the email later on and take a look at all the amazing content that both Dale and Jose provided to us. We are here for you. We are safe, sound, and secure. Please take a look at our deposit products, etc. That's my little sales pitch. Please stop by and visit us at the branch next week. And also we have more amazing webinars coming down the pike. So we have about, 6 to 7 coming down in estate planning in the early part of the month. And then we also have our annual meeting coming up on May 14th. So be sure to look out for all the announcements. Thank you to Jose and Dale, and have a great day, everybody. Thank you.
Thank you, everybody.
Thank you, everyone.